Welcome to Talk Tickers, the deep dive where we break down complex earnings calls into the insights that matter for you.
And today, we're tackling Fifth Third-Bancorp's Q3 2025 call. Definitely a significant one. You had regional banking volatility as the backdrop, plus this huge Comerica merger announcement hanging over everything.
Absolutely. So our mission today, it's pretty clear. Unpack those headline results, which, well, they had a big hiccup we need to discuss, and then really get into the strategy behind merging with Comerica.
And maybe most important, how management handled those questions about credit quality, particularly, that NDFI exposure everyone's been watching.
It was definitely a mixed bag of a quarter.
It really was.
Yeah.
I mean, on one hand, the underlying business looked quite strong. But then you had that one very large provision expense that kind of overshadowed things.
Okay, let's start with that operating engine then, because like you said, the core numbers were actually pretty good. Adjusted EPS came in at $0.93, but the real story, I think, was the operating leverage. That adjusted pre-provision net revenue, PPNR, basically the bank's core profit before loan losses.
Yeah, the core earnings power.
Exactly. That was up 11% year over year, which gave them, 330 basis points of positive operating leverage?
That's right, 330 basis points. And that core revenue growth is so important here. Adjusted revenue overall up 6%.
Driven by?
Well, you had net interest income, NII, up 7%, and fee income growing 5%. Pretty balanced.
And the balance sheet showed that momentum too, right? Average loans up 6% year over year.
And not just up, but accelerating. That's the fourth straight quarter they saw faster loan growth.
Okay, and what about funding? Deposits holding up?
Seemed like it. Consumer demand deposits, the DDAs, they were also up 6%. So, yeah, on the surface, it looks like a bank that's executing pretty well.
But there's always a but, isn't there?
There is. And this quarter, it was that huge $200 million provision expense tied to the fraud over TriColor.
Yeah, management was pretty blunt about that. Said it really marred what was otherwise, quote, an excellent quarter.
We should probably clarify that TriColor issue just a bit, because you hear provision, especially now, and the market immediately thinks, oh no, systemic credit problems.
Good point. What exactly happened there?
So this was really specific and painful, I imagine. TriColor was an indirect auto lending partner.
Okay.
The fraud involved basically misrepresented loan applications, a huge breakdown in due diligence that Fifth Third ended up having to cover.
So less about the whole consumer book going bad and more about a failure with one specific third-party relationship.
Precisely. It sounds like an operational risk failure, not a sign that, all their auto loans are suddenly defaulting. By taking that full $200 million hit now, they're basically saying, okay, we're drawing a line under this, isolating it, moving on.
Right, containing the damage. So if the underlying bank health is actually pretty solid, that brings us straight to the really big strategic news, the Comerica merger. Management spent some time laying out their M&A philosophy. It has to hit strategic goals, the financial return, think IRR, earn back period, needs to be better than just growing organically.
And the outcome needs to be a better, not just bigger bank. That was the phrase they kept using.
It's a good line, better, not just bigger. But what does that actually mean in practice here? Why is combining with Comerica better?
Well, look at their strengths. Fifth Third is really good at gathering retail deposits, right? They have this deep, relatively low-cost funding base.
Okay.
Comerica, on the other hand, brings this really strong middle-market lending franchise, especially in faster-growing segments, plus expertise in specialized areas like tech and life sciences lending. High growth, potentially higher margin stuff.
So Fifth Third brings the cheap funding fuel, and
Right.
Comerica brings the high-performance engine, so to speak, leveraging Fifth Third's deposit machine in Comerica's markets.
That's exactly the idea. You can see the blueprint in how they've grown organically in the Southeast already. Consumer households down there grew 7% year over year for Fifth Third.
And
Critically, the cost of those retail deposits in the Southeast averaged just 193 basis points. That's really cheap funding in this environment. That's the competitive weapon they plan to deploy.
they're doubling down on that playbook.
Seems like it. They're opening another 27 branches in the Southeast by the end of this year. And then the plan is to take that same model and apply it aggressively in Comerica's territory, especially Texas. They mentioned plans for 150 new branches there.
Wow, 150.
Yeah. The goal is to end up with a major presence across 17 of the fastest growing large metro areas in the U.S. Big geographic footprint shift.
Okay, let's pivot then to the issue that's been giving bank investors nightmares. NDFI exposure. Non-depository financial institutions.
Right. This became a huge focus after, some recent liquidity issues with certain non-bank lenders. The worry is always contagion could losses in one niche lending area spread.
So how did Fifth Third address this? Because the market was definitely looking for answers.
They were clearly ready for it. They came out with a lot of detail, which was smart. First, they emphasized their overall NDFI concentration is already pretty low, around 8% of the total loan book.
Which is low compared to peers.
Yeah, they said it's one of the lowest among the large banks. But then they did something pretty helpful. They actually broke down that 8% portfolio by the type of risk.
Okay, that's useful transparency. What did that breakdown show?
Well, the biggest chunk, about 33%, is lending to REITs and mortgage facilities. And here's the key point they made. 0 losses in that specific bucket over the last 10 years.
0 losses in 10 years. Okay, that definitely helps de-risk that portion in investors' minds. What else?
Another 24% is lending to established firms like payment processors, insurance companies, brokerages, generally seen as pretty solid counterparties.
Mm-hmm.
Then you've got about 18% in subscription facilities. Those are usually highly secured loans linked to private equity funds and their investors.
Right, often seen as lower risk.
Typically. And then the part of the portfolio that actually included TriColor, the consumer asset classes, that was the smallest piece, only about 9% of the NDFI total.
So the area that caused the $200 million headache was actually the smallest part of their NDFI exposure.
Exactly. So the takeaway wasn't that Fifth Third has some massive hidden NDFI problem. It's more like they have a collection of distinct, specialized lending businesses, mostly well secured.
And there was a forward-looking point related to the merger too, right?
Yes. Crucially, once the Comerica deal closes, the combined bank's NDFI concentration is actually projected to decrease further, down to about 7%. So in a way, they're using the merger to make their overall risk profile look even better relative to peers on this specific issue.
That's a really interesting strategic angle. Okay, let's talk future profits. Net interest income, NII, management seemed pretty positive about the trajectory there.
They did. They highlighted a big structural tailwind. They've got something like $4 to $5 billion per quarter of older fixed-rate assets maturing and repricing higher.
And what kind of lift are they getting on that repricing?
Right now, it's around 100 basis points. So the new assets are yielding about 1% more than the old ones rolling off.
And that continues for a while.
Yeah, they expect that positive repricing impact to keep boosting NII all the way through the middle or even late 2026. That gives them a really predictable source of revenue growth baked in.
That's a nice foundation.
Yeah.
But their comments on deposits before the merger closes were a bit counterintuitive, weren't they? They guided deposit betas lower, like in the 30% range for Q4, Q1, even if the Fed cuts rates.
Yeah, it does seem a bit odd at first glance. But it's intentional. They basically said they're not going to aggressively chase every last high-rate deposit right now.
Why not?
They want to maintain a strong mix of core retail deposits, their traditional strength. They're kind of building up liquidity and flexibility so that after the merger closes, they can deal with some of the potentially higher cost funding sources that might come over from Comerica's balance sheet.
Ah, okay. So it's about being disciplined now to have the power to optimize the combined funding base later, preparing the balance sheet for the integration.
Exactly. Keeping their powder dry, maintaining that low-cost advantage strategically.
Makes sense. It really does sound like Q4 is about setting the stage for 2026 and beyond, which naturally brings up the question of execution. Can they actually pull off this massive Comerica integration smoothly?
That's the billion-dollar question, right?
Yeah.
Management tried to build confidence by pointing to their track record on efficiency.
What did they highlight there?
Well, look at what they've done organically. Since 2019, total headcount is actually down 8%.
Down 8% while growing.
While growing, yeah. Adjusted revenues are up 20% over that same period. They attributed that to technology investments and process improvements, these value stream savings programs. They expect about $200 million in annualized run rate savings from those efforts by the end of this year alone.
Okay, that efficiency track record is impressive. But integrating a whole other bank, especially one the size of Comerica, while also maybe trimming staff, doesn't that create huge risks? Like employee morale, culture clash, things falling through the cracks?
That's a fair concern. They didn't dwell too much on the cultural side on this call, but they really hammered the technical integration advantage. And this might be the underappreciated part of the deal.
What's the advantage?
They are not trying to stitch together two different core banking systems. That's often where big bank mergers really stumble. Instead, Comerica's customers and businesses are going to be migrated entirely onto Fifth Third's existing platforms.
So one core system for the combined bank.
One system. It simplifies things massively, reduces technology risk, integration headaches. That operational competence and clear tech plan seem to be why they feel confident.
And that confidence carried through to their Q4 credit outlook, despite the TriColor issue in Q3.
It did. They expect net charge-offs, NCOs, to drop quite sharply in Q4, back down to around 40 basis points.
Which signals?
It signals that they truly see TriColor as a one-off event that's now behind them. And they also noted that underlying consumer credit trends, like delinquencies, were looking stable to even slightly improving.
Okay, so let's quickly recap the Q4 guidance. NII stable to maybe up 1%, adjusted non-interest income up 2-3%, helped by seasonality in capital markets.
Right, and that flows through to full-year PPNR, that core operating profit growing 7-8%. Pretty solid outlook.
And zooming out, the big picture strategy for the combined bank is leverage that bigger footprint in those 17 growth markets.
Yep, and push harder into higher margin areas where Comerica is strong, like tech and life sciences, the innovation economy stuff. They really believe that combination of footprint, specialty lending, and that integration advantage sets them up to hit their long-term targets.
Which are pretty ambitious efficiency ratio down in the low to mid 50s, and a return on common equity, ROCE, around 19%.
Very ambitious, but they laid out the path.
Okay, we've covered the results, the strategy, the risks, the outlook. That brings us to our favorite segment, where we brainstorm an outrageous but maybe plausible trade idea based on everything we just discussed. And the usual disclaimer applies.
Loud and clear, this is not financial advice, just analysis for discussion and, frankly, a bit of fun.
Absolutely. So what's the big idea sparked by this call?
Okay, so looking at how the market seems to be treating Fifth Third stock right now, especially with the merger overhang, it feels like there's too much pessimism baked in about the execution risk.
You think the market is underestimating their ability to pull off the Comerica integration?
I think so, especially given that tech platform advantage we talked about. No messy system blending and their proven efficiency track record. Plus, the call provided a lot of clarity that should dial down the NDFI fears.
Okay, so if the market is too worried about execution risk, what's the trade?
The trade idea is short the M&A execution risk narrative. Go long Fifth Third, maybe using something like deep in the money call options, targeting early 2027.
2027 specifically. Why that time frame? Is that when you expect peak synergies, or is it tied to that asset repricing story?
It's really the combination of both hitting full stride. You've got that integration bedding down, hopefully proving the doubters wrong. You have the NDFI concerns hopefully faded into the background. But crucially, you also have that predictable NII tailwind from the $4 or $5 billion in assets repricing higher every quarter continuing through late 2026.
Right.
Plus, you'll have the positive impact of purchase accounting adjustments from the Comerica deal flowing through the numbers. It creates this really strong, predictable revenue floor for several years.
So the bet is basically management executes better than feared, the NDFI risk is contained, and this built-in NII growth plus deal accounting helps them hit those big targets, that 19% ROCE, the efficiency goals faster than the consensus currently expects.
Exactly. Faster than expected, warranting a valuation premium compared to other regional banks, hopefully before those 2027 options expire. The underlying earnings power floor just looks much higher than the market seems to be pricing in right now.
A very specific thesis, grounded right in the call details. Compelling. So, final thought for our listeners today. What's the main takeaway?
I think the Q3 call really painted a picture of a bank that knows its strategy. It's using its strong organic engine and cost discipline to make a truly transformative acquisition. Yes, they hit an operational pothole with TriColor, but they dealt with it directly. Now, they seem structurally positioned with that repricing tailwind and the integration plan for significantly higher profitability heading into 2026 and beyond.
A clear path forward, despite the near-term noise. Excellent summary. And just one more time, remember, folks, all investing involves risk. That trade idea was purely for discussion and entertainment.
Definitely.
Thank you for joining us on Talk Tickers for this deep dive into Fifth Third's quarter. If you have thoughts or questions on this, please do reach out to the team. We'll see you next time.